So afternoon, everyone. Thanks for giving us the opportunity to present to you again. I think this is my third or fourth year here to present to you at the start of the year to just show you a bit of our outlook, what we think the market will be like this year and where we see the opportunities are. Okay, so I'll bring you through a very bird's eye view of the global economy. We'll start off with the most important economies in the world first, US, Europe, and China. And then we'll talk a bit more about Malaysia, our home market. And then I'll talk a bit about our funds that we offer at Kenanga. Okay, let's start with a bit of recap on what happened last year. So I think last year was a pretty good year for markets overall. I think markets that did well was actually the US, Taiwan, and Hong Kong. And underperformers were actually Korea, Indonesia, and Thailand, which were actually down almost double digit. In Malaysia, actually, we did see one of the best performances so far, in the last decade. We saw actually the KLCI up almost, mid-teens percentage points. So actually, last year was overall a good year for equity investors. Okay, let's start off with by, having a big picture of what's going to happen. And of course, the key driver that affects the rest of, the whole world is, of course, the USA. So what happens in the USA does affect what happens in other markets as well. So for US, I think growth has been very resilient. We see actually 2024 growth, the forecast would be actually 2.7%, but this year is expected to slow to closer to 2%. So the US actually has been quite surprising. A lot of people saying that US might enter recession, but so far we haven't seen any signs yet. And actually the strength it has indeed took a lot of economies by surprise. In terms of inflation, I think in the last 2 years, there's a bit of concern over high inflation in the US, but that is actually becoming less of a problem, with inflation coming down to close to 3% last year, and this year expected to moderate further to 2.5%. And so that has allowed the US to actually start cutting rates, last year. So we actually saw the first cut of the cycle in September last year, reducing the interest rate by 50 basis points. And I think there was actually 2 further cuts last year. And I think the question right now we are facing is that, interest rates have already started to be cut, but, can they go down even further? And I think the last 2 months, there's been a bit of concern that, US might not be able to further cut its interest rates, and that's why there's been a bit of volatility in the markets as well. But I think, given what we see this year, there will probably be approximately, 1 to 2 cuts interest rate. So at least, we are on a down cycle. Because I think this matters to the rest of the world because US interest rates is actually a key attractor of capital. So to put it simply is that money goes to where they can find the highest return. So if US bonds last year were giving you, 4.5% to 5% return, a lot of money actually flowed to the US, and this was actually negative for emerging markets. So it is key that, if the US continues to cut interest rates, the rest of the world, and especially emerging markets, can benefit. Okay, Trump 2.0. Of course, he's going to take office very soon on Monday, a highly anticipated event. And we think this is actually positive for the US market. A lot of his key policies are actually pro-growth. Number 1 being tax cuts. Number 2 being deregulation. But of course, the negative part of his policies is actually tariffs. Will probably be an increase in tariffs of products imported into the US, and that is actually negative for a lot of key emerging markets. But we'll see how it goes. Trump is famously known to be a tough negotiator, but he normally starts with very, very tough talk, and then he normally brings it down later on. So it's still yet to be seen, but something that we are closely monitoring. And some of the themes that we like in the US is actually the AI theme. We think that AI is real, and it's actually driving a lot of improved productivity in US companies, and it's actually driving an investment cycle. So I think companies are actually accelerating their spending, accelerating their capex programs. They are actually pouring a lot of money into this because they believe that this is a game changer. And if one company, invests, your competitors also need to invest, because if not, you're going to be left behind. So there's actually a race, to actually determine who can be the winner. So we see a lot of the key companies, the big 5, we call it, Microsoft, Alphabet, Meta, Amazon, actually investing a jump actually in their spending. So if you see the orange line, that is the expected spending increase. So you see it's a step higher than where they were in the last few years. In 2025, this big five are expected to spend 300 billion in terms of capex, capital expenditure, to actually improve their capabilities in AI. And this is actually something that they really believe in. This year, a lot of experts say this will be the year of what they call it agentic AI, meaning AI that can help you solve a task. I mean, I'm sure we're all familiar with ChatGPT. If you haven't, you can just download it on your iPhone, your app, and actually you can start using it to ask questions. And actually, this experts believe will actually broaden further into the companies, where companies actually use AI to help solve their problems. So instead of, let's say, going to HR to ask for your payroll processing, your data, HR will have an AI agent that will actually help each department, to actually process their payroll processing, just for example. And there are many, many more examples. I think in a recent interview, actually Mark Zuckerberg, the CEO of Meta, actually announced that the AI that they have is as good as a mid-level engineer. And that is why actually they're reducing their staff force in the US. They've announced staff reductions. So this is actually really having an impact right now. It's not something in the future. It's not something 5-10 years later. It's actually happening now, and it's actually impacting the productivity of US companies. And so actually we see that this year will be a year where a lot of companies race to deploy these AI agents as well. And there's a whole list of beneficiaries that we can explore and that we are looking at. So I think it will be a good year for investments in AI as well. Of course, AI, it can be up and down. Sometimes there can be a bit of a hype cycle. Investors chase hype and cause valuations to go up. But I think over the long term, we will see the growth start to come through. And of course, but we need to be a bit careful on the valuations as well. So moving on to the second biggest player in the global stage, the European Union. I think not much to say here. I think EU has been on a slow growth trajectory. It's a bit anemic. I think last year we only saw less than 1% growth. I think this year will also be around the 1 to 1.3% range. So, but what's positive is that actually, inflation is trending down, and the inflation is actually forecasted to be closer to 2% this year. So in terms of where interest rates in the European area are trending, they are actually on the rate cut cycle as well. So we see the chart on the right, we see that the European Union inflation, given by the CPI number, has actually started to trend down since 2 years ago. So right now it's stabilizing at close to 2%. So this gives the ECB, room to further cut interest rates there. Right now it's at 3%, and there's possibility of further cuts this year as well. So at least in the two major economies, in US and Europe, it's a possible downtrend in terms of interest rates. Okay, the third, biggest player in the world economy, China. Of course, a very key topical issue. There's been a lot said about the slowdown, and indeed, actually, China is grappling with a property downturn into the second year already. So we see, chart on the right, existing home sales in 70 major cities has actually been deeply negative for the last few months. But at least right now it's stabilizing, and I think it's yet to be seen what the government does to help further stabilize this property market. If you look at the chart on the left, it shows you the dark blue line shows you the real estate development in the economy, which has been negative, trending negative. So real estate is a very big sector. I think the previous presentation pointed out that most of the Chinese people, their household assets are invested in property. So it affects a lot of things, consumer confidence, construction sector, property sector, home furnishing and fitting. So it affects a big portion of the economy. But I think on the positive side, we're seeing a more aggressive stance by the government. So I think the recent tone was actually, there's been a lot of change in wording, and I think the Chinese are very particular about this. When they have a change in the top direction, everybody follows suit. So we see actually even the president himself calling for more aggressive measures to support the market. And there's been a lot done actually. I won't go through it in detail, but they have actually put on all levers. So they have increased fiscal spending. They have promised to actually borrow more money to spend on infrastructure. They have loosened the property policy in terms of down payment requirements and all the other requirements, they've loosened it, and they've also actually cut interest rates many times. So just to highlight a few bit, I won't go through in detail, but they have actually started to increase the amount of stimulus that they give into the economy. And as the meetings roll by, you see the list get longer and longer, meaning they're getting more and more aggressive in supporting the market. And I think they will actually, turn up the tap again in the upcoming March meeting. So on the positive side, we see that the government is really serious this time. I think previously we understand on the ground that a lot of officials were, in the last few years, they were afraid to act because they were scared of actually doing too much. But now I think the focus has shifted. We understand now a lot of officials are trying to outdo each other in trying to come up with new stimulus policies because the direction from the top has changed. So direction from the top in China is very important. So overall, putting it together, what is our global market strategy? I think in the US, we still see resilient growth there and a supportive monetary policy to provide support to equities. I think AI thematic will be one of the key investment areas alongside Trump policies such as reduction in tax and deregulation, which will benefit the banks. But also bear in mind that there's a bit of policy risk in terms of tariffs, and the valuations are also a bit high. But overall, we still lean towards the positive side in US. What about our strategy in Asia? I think in China, we're a bit more positive, given that the government has turned much more aggressive in stimulating the economy. But nonetheless, we still think that more measures are needed to sustain the market momentum. So we are quite selective in China. We focus on the companies which will benefit from government stimulus, such as consumption, key exporters that the government wants to support, and we are cautious on sectors that are still in the midst of a downturn, like property and construction. So in terms of Korea and Taiwan, we still like it, given there are a lot of tech companies in Korea and Taiwan that will benefit from the AI thematic. In ASEAN, I think ASEAN is going through a bit of a rough patch at the moment. I think growth is slow outside of Malaysia, and they are still struggling with the high interest rates in the US, which is actually taking back capital from EMs like ASEAN. But nonetheless, I think there are still pockets of opportunity, especially in Indonesia, which still sees a lot of FDI, and of course Malaysia, which I'll talk more about in the next section. Okay, so let's move on to Malaysia, which is our home market. Okay, Malaysia, our home ground. Let's see where the opportunities are. I talked about US, we have the AI thematic there. But here also we have AI, which is our Prime Minister, Dato Sri Anwar Ibrahim. And it's been doing a lot actually to boost the economy in terms of fiscal reforms. By fiscal reforms, I mean actually reducing the subsidies and actually spending more to develop infrastructure. There's a lot of pro-growth policies, a lot of acronyms here, but like the new energy policy, the Malaysia plan, the Johor-Singapore Special Economic Zone, which you saw recently. So these are all helping to stimulate investment. Also the National Semiconductor Strategy, which aims to bring in FDI into the country. And this has led to the new investment cycle. So you see what has been driving growth in emerging markets in the last 10 years is that whenever there's an investment cycle, the market tends to do well. I think just now you heard from the speakers that, in the last 2 decades, China went through an investment cycle. India now is going through an investment upcycle. So when there's an investment upcycle, it tends to benefit the market as a whole. So Malaysia also, there's a mini investment cycle, I would say. So let's talk a bit about the macro backdrop before I talk more about the specific policies. So in terms of overall growth outlook, I think last year we did, I think growth will come in towards 5%, maybe 4.9 to 5. The final number is not out yet, but at least it's a very strong showing for a small country like Malaysia. In terms of where the drivers were, it was actually investment, like I mentioned. But of course, there are risks, to Malaysia's growth as well. Number one being the tariff policies that might be implemented by the US president. For 2025, I think growth should also still come in towards the higher end of 4.5 to 5%. In terms of inflation and interest rates, I think inflation last year, came in below 3%, and this year expected to further moderate to closer towards 2.5, right? But of course, that depends on whether the government does go ahead with the petrol subsidy removal or not. If they do, then inflation might come in slightly higher. But based on our analysis, I think Bank Negara is still likely to view this as one-off and actually might not increase interest rates. So the forecast right now is for Bank Negara to maintain interest rates at about 3%. So I think inflation is under control. And in terms of fiscal reform, I think it continues. So the budget deficit last year was actually probably come in better than expected. In terms of 2024, the budget deficit forecasted 4.3, but I think the final number might come in closer to 4.1. And I think this year will further moderate to 3.8. So that, eases some concern among international investors that the government spending is unsustainable because it's been on a declining trend in terms of the budget deficit. So actually last year's diesel subsidy removal actually saved the government 7.5 billion, which was higher than expected. Because once you close the diesel subsidy, you actually eliminate a lot of illegal activities like smuggling and all. So the finance minister recently said in a conference that the savings that they got from the removal of diesel subsidy was higher than expected. Of course, the petrol subsidy petrol subsidy removal might affect consumption, but the government has also mentioned that they will only be targeting the T15. So I think the bulk of the population will still not be impacted by the petrol subsidy removal. I mean, how they're going to implement is still yet to be seen, but at least this is what they've talked about. So T15 accounted for 40% of the subsidy on Round 95, worth about 8 billion. So if they can remove that, maybe they might save 4 to 5 billion in terms of savings. And this money they can then redeploy into infrastructure. Okay, FDI. I think FDI is one of the key themes in Malaysia. We see rising foreign direct investment coming in. For the 9 months of 2024, we saw 250 billion in approved investments, which was actually higher than 2023. That was the total approved investments, and FDI contributed about 42% of that. So we see a rising investments in Malaysia. One of the key themes of the investment is, of course, data center investments. So in 2024, 10 months, we saw actually 141 billion, which is 3 times the approved digital investments compared to 2023. And this will further increase this year. So the major hyperscalers, Microsoft, Amazon, Google, and Oracle, have committed a total investment of US 23 billion in cloud infrastructure. Of course, I know there's been some noise in the market recently, for those of you who follow it closely, that there might be some limitations in terms of the data center investments due to new rules proposed by the US government. That has caused a bit of sell down in the market in the last week, the last few days. But bear in mind that these rules are still very preliminary. They're still just a proposal and subject to change by Trump. And also, even if these rules are applied, we believe that these rules will actually I wouldn't say it stops the investment, but it will just make the investment more gradual over a longer period of time rather than all at once, which is what the companies are trying to do right now. So with this limitation, basically it means that the companies they have to space out their investments into a longer time frame. And in the long term, actually it could prove to be actually more sustainable as well. But the rules are still in a draft stage, so let's see what happens. But I think overall, in summary, the net benefit is that I think data centers will still continue to be a positive driver for Malaysian investments going forward, despite the new rules that was proposed. So strong FDI, don't worry if you can't see it, but this is just to highlight that there are many different companies interested to invest in Malaysia, ranging from US companies like Google, Microsoft, but also to even Chinese companies. So I think Malaysia holds a unique position in that, we attract investments from both sides of the camp, be they US or China, we are friendly to all investments, and that's always been our strength, which is our neutrality. Another key, investment point to highlight is also our new energy policy, which aims to actually increase the percentage of renewable energy in our energy mix. I think to target 30% in the short term. And don't worry about the chart, but basically the government has actually been spending a lot to actually award, new projects in terms of solar construction, wind, hydropower. So actually this is also triggering an investment cycle in the renewable energy space. Infrastructure rollout is also number 3, another pillar of our infrastructure plan. So we have seen more and more projects coming up as well, and the government is actually spending a lot also on development expenditure. So just some key projects to highlight is, the Penang LRT has already been proposed and broken ground last week. We also see another LRT proposal in actually Johor. And the Johor-Singapore RTS, once it's open in 2026, will also allow the free movement of people between Johor and Singapore. And this all ties in with the special economic zone. And so we see a lot of developments happening both in the north and the south. So on one hand, you got Penang, the semiconductor hub, and the government is trying to bring in FDI there. And we also got a southern hub as well, which is the Johor-Singapore Special Economic Zone. So all this is actually a boost to property. You know, you got more infrastructure, you got actually more activity, and this is positive for property values, of course. And we see actually a rise in terms of residential transactions already across the board. So overall, what is our investment strategy in Malaysia? So we still remain positive in Malaysia despite the strong year last year. We think fiscal reforms and pro-growth policies will continue to support the investment upcycle. But nonetheless, I think we need to be selective. Last year was a broad-based rise in the market. So now you need to look for more undervalued stocks and maybe potential laggards. But this year could also see a bit more volatility, given the new US president and potential news on tariffs and restrictions. So sector strategies that we still like the infra sector. We like the financials, the banks, which will benefit from broad-based growth. We like the property sector, renewable energy, and also healthcare. For tech, I think we still like it as a long-term play, given the diversion of manufacturing out from China into other more neutral areas like Malaysia. Okay, that brings me to the end of my presentation. For the last part, I'll just go into a bit of our key funds highlights. So this is just to introduce you to some of our funds for those who are new here, and just to highlight to you which funds are focused on what areas. So, this is a fund and a performance, but the performance, 1 year can be volatile, but we encourage you to look at a long-term track record, which we believe we have a decent track record there. For the first three funds, those are focused on Malaysia large cap funds. So Kenanga Growth, Sharia Growth, and Blue Chip. Those are more looking at the large cap sector in Malaysia, which did very well last year. Kenanga Growth Opportunities is a small cap focused fund, which could see actually better returns this year after large caps have done well already. Kenanga Malaysia Incorporated Fund and Growth Fund Series 2, those are balanced funds, so they are mixed between Malaysia and regional as well. And then also we have our global series, which is our Kenanga Global Growth Fund and our Global Islamic Fund, which actually did decent last year, although not as high as Malaysia. But bear in mind, fund returns are cyclical, right? In 2023, the global funds did better than Malaysia funds. Last year, Malaysia was the darling, of course, but we encourage investors to have a diversified portfolio of funds. That's why we show you this whole table. You can diversify between the foreign funds as well as the local funds that we offer. And not to forget the bond funds as well, Bond Extra and Asnita Bond Fund, which give you that defensiveness that you need in times where markets are highly volatile. So by having some allocation in bonds, that when the market comes down, you can reallocate out of bonds in equities, and that gives you a buffer as well. So this is our list of funds, and I hope that you continue to support us in the years to come. Thanks.